You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome to the show, Danielle.
Hello, Jim.
$10 oil? Is that realistic?
It seems unbelievable, doesn't it? But, you know, historical perspective is very important, and I think that chart that we put on the blog today of West Texas crude offers that perspective all the way back to, 1996. So longer than most people today have memory for sure. But it just shows that, not only is oil a barometer of the broad economy typically and the demand cycle in the world, but it also tends to be a highly financialized asset, especially in the last 15 years. So whenever we've had these spikes in liquidity and credit and leverage throughout financial markets, we've seen, a big pop in the price of oil. So that was really something that happened with spades in the latter part of 2000s, in, say, 2005 to 2008, when we had the massive credit bubble build in the world and then a pop. And as you remember, oil went to 147 at that point. It had been 10 in 1999, just as it had been around 10 in 1986. Anyway, so you had that pop where prices, dropped and then quickly rebounded on the whole stimulus, financialization, liquidity back into financial markets, out of the bottom in 2009. So really, as you and I have discussed before, what that did was it gave a lot of incentives to financial intermediaries to do all sorts of inappropriate hoarding, storing, trading, manipulating, making derivative positions off of, and the Federal Reserve aided and abetted that in the United States by giving letters of permission to these investment banks to do all these activities, which heretofore was considered illegal and inappropriate and widely recognized as undesirable for the society and economy as a whole. In any event, they went with wild abandon into those spaces to make quick profits wherever they might, and what happened was we saw a big resurgence in price. Now that was a very bad thing for producers and who were looking at that price signal as evidence of demand, in the sense that they ramped up their production. And that happened all over the world, Jim, all in concert. And so you have now, even with the plunge in price in the past, 8 months, you have the highest production you've ever had in the world. And guess what? The forecasts are that you're going to have probably 25% more production in the next year, notwithstanding the fact that many of those operations have become net negative on a cost basis. So you've just, it's good for consumers who need all the breaks they can get today, frankly, with the encumbrance of debt and low wages and underemployment that's rampant throughout the real economy. But it's bad for producers and governments who are collecting revenue and who have done budgets based on a revenue of 50, 60, 70, 80, etc. oil, when in fact, with the massive production and the still weakening demand, I think that you could see oil go much deeper here, much lower than anyone has factored into their spreadsheets. And that's the vulnerability of the overall stock market, of the overall financial markets, of banks, of economies, because everyone is unduly levered to this one particular asset, and because, another report out today, Goldman Sachs is, they call it their swirlogram. It shows a contracting global economy, confirmed today. Again, we've been saying that on many of the indicators we follow. So it's not just that there's this massive supply and that it's going to continue to surge in the next year or so, but that you have this contracting global economy part. And so all told, I think it's quite possible. Don't forget that we got to 147 on the upside with the credit boom, right? And everyone recognizes in retrospect that 2008 was what they call the Great Credit Bubble. But we have some $60 trillion more of debt in the world today, Jim, than we had in 2007. And much of the leverage and derivative and excess leverage that came off of that increase in debt has gone directly into financial assets, and so, including oil. And so when you get a mean reversion of that much leverage, you get a mind-boggling, an equal and opposite in the opposite direction is typical. So I think you could see a retest of, in the $10 to $20 a barrel range very easily. And, again, not the consensus has not been prepared for any of this. So, that makes companies and everyone more vulnerable when they haven't prepared for this, quote, rainy day in price.
There seems to me, though, to be pretty much a disconnect between the price that they're paying at the oil head and the price that they're paying at the pump. Gasoline prices in the Vancouver area up 12 cents a liter over the last few weeks. What happened?
Well, there was a little pop, right? We had oil popping there for about a week and a half, and perhaps some people were optimistically calling a bottom at that stage. And you don't have a direct correlation in decline in oil with the price of gas at the pump. Typically there's always a lag, and there's a spread, and there's profit margins, et cetera, for the producers and the companies that are selling it on a retail level. But anyway, I think what we've seen the last few days is that the pop in crude that we noticed has largely come off. It's back around $51 a barrel today, and I think there's a lot of factors. There's a lot of the risk in the euro right now is partly to blame because it's again pushing back up the U.S. dollar, and when the U.S. dollar increases, you get that reciprocal decline in commodities like oil. So it could be that the Greek standoff that's going on right now in Europe. They aren't yet at an agreement in terms of further extension of terms or time for their bailout. And one of these days, someone there is going to blink, and you could find that the Greek exit happens. What I think is the most let's say dangerous for most financial markets today is that they've become so complacent in the past few years. They've become so confident that everything will work out, that central banks and governments can just continue to extend and pretend, that they really don't take any of these risks seriously. So you still see a very low VIX, and you see, a lot of people complacently riding whatever stock bubbles are available, saying, oh, well, I don't see any sign of a downturn or any reason for concern, and surely policymakers will figure this out, as they have in their view for the past 4 years, so they're not concerned. But I think that's precisely when you're the most vulnerable, because all you need is to have one random headline, come like, for example, that Greece has decided to not take a further bailout and to actually exit the euro and go back to the Jockman. I think you could have a violent repricing in many asset markets, which will again, it's the violent swings that wipe out the levered players, and that has the knockoff effects to everything else. But every data point year to date, Jim, has been basically there's been very few things that have surprised to the upside. So the economic disappointment index is very widespread right now, and inflation gauges are all plunging again in 2015. All the key things like PPI, CPI, PCE, all these different, consumption expenditure indexes and that sort of thing have been plunging over the past 8 months with the price of oil. So really what you're getting is this widespread deflationary effects again. So you and I have talked about how, the demographics, the aging demographics, people say, trying to, not spend but downsize, spend less, and then you've got the weight of low rates pushing savers into a point where they can consume less, the aging population who just naturally consumes less, and now you've got things like, the price of oil plunging so much that inflation gauges are all going south in a hurry. Now, again, that can be positive for consumers because that means they'll be able to buy things at cheaper prices. But when you've got a financial market and basically sector that has been so babied and coddled and given such unfair advantage the past 4 years, in all the QEs and interventions and free money. You just have a system that's inherently fragile and unprepared for any kind of adversity or unexpected result. And so, I think the Fed at best in the U.S. is going to have to stay pat. We saw that with the Fed minutes this week. They were worried about the downside. They're looking at this contracting data and saying, oh dear, maybe we won't be able to raise rates as we had so confidently predicted. At the very most, that means that they aren't able to cut further from here. We know they're already at, virtually zero. They had so wanted to get rates higher a bit so they'd have some more to cut when the next downturn arrived, but it seems the next downturn is already upon us, and they're going to be left sitting there with no bullets in their gun and no ability to rejig this, which ultimately will be positive, frankly, because you get some truth and some price discovery, as you may indeed get in Greece right now. The first person to blink to admit that this debt can't be paid is going to be the epiphany for the entire financial system. That's very interconnected right now in the world. So, it's the currency wars that are hitting right now, massive volatility in the currency markets, $5 trillion a day of trading in currency, and we're getting the highest volatility we've seen in that major market since, the Asian crisis of 1998 and the financial crisis of 2008. So I think it's quite remarkable. And it's those big shocks and moves that can very poorly be absorbed by this overextended financial sector.
And just going back to the gasoline prices, I point out to everybody that every spring there's always a fire or an explosion at some North American gasoline processing plant, and that's happened in California today. So every spring this happens. You can just check your news reports. Every spring, some refinery in North America has an explosion or fire. And of course, there's your excuse for radically boosting prices for the summertime.
Well, are you suggesting it's somehow staged or intentionally set? I mean, I wouldn't put it past them, but I would point out to you that there's actually pretty regular stream of catastrophic events flowing from our obsession with petroleum products. I mean, whether it's a train derailment or an ocean spill, fires of various kinds, truckers.
But they never mention them about price until you ask, how come that big hike in the price this spring? Well, we just had a refinery fire, at Cherry Point in Washington State, so.
Well, I think it's interesting too is, all this clatter about, the lower price of, gas and oil and heating oil too. Half the American homes are heated with, natural gas, and that price has come off significantly. So all those things ease up some of the fixed costs on consumers. But what's really remarkable is that it is not feeding through into the retail sales numbers. And I think that's really taking the confident crew by surprise. Not so much me, because I'm looking at the data and saying, okay, they're feeling extremely stretched already. They've got tons of debt payments. They've got all these car loans or leases, whether they're zero interest or not. Their payments they're committed to, negative cash flow on a monthly basis. So having less energy costs is a help, but it doesn't mean they can dramatically go out and increase their spending. So I think that's another thing that's been disappointing the bulls lately is just that revelation that not only is are the price of energy this key staple for North American sales and revenue, let's say, of these companies. Not only is that plunging, but we're not seeing a pickup that everyone had hoped for on the consumer side. It's interesting. We had talked about on the corporate side how some 25 to 30% of capital expenditures in the entire world were fueled by energy companies. And it used to be that people would talk about Caterpillar, the big manufacturer of equipment, heavy equipment, as being this big barometer of global demand. And, when it was always going up in the credit boom there, a lot of commentators would point to Caterpillar as the only, company you need to watch, go there because their earnings kept knocking it out of the park quarter after quarter. Well, in fact, Caterpillar has had now 26 consecutive months of declining sales, right? And when you look at their recent January data, which they just reported today, it was the worst retail sales month since the Lehman the Lehman Brothers fiasco when everything blew up. So if we're looking at any of these things in the real world that indicate demand both in the commercial sector where cutbacks are coming, in big waves every day from the energy sector, which was essentially driving the bus for the last few years. You're seeing all this slashing of the capex. You're seeing layoffs on a daily basis. You're seeing consumers retrenching. And, that's why the global economy is weakening again. So there was another really interesting article this week, Jim, and I put some of it on the blog about, how big papers, the Telegraph, for example, in the UK, which has traditionally been the source of journalistic integrity, historically was bought by Barclays Bank and a number of years ago, and has been sort of taken over as this, not so much a journalism company as a, massaged message company owned by a big bank, run for big banks. We've seen this really everywhere. I would suggest to you it's why, alternative media like, Talk Digital Network and many of these places have gained such a following in the past few years. Has this been this, incremental sort of taking over of any kind of free or true or accurate reporting on so many of these sectors, and finance being the dominant one. Not only are they controlling so much of the policy, the regulators, the politicians, they're paying the big bucks to the advertising dollars too. One of the reasons that this article came up this week was that one of the main editors, global editors and commentators, finally gave up his post and resigned, saying that he simply couldn't work for a place that was so dishonest in their coverage. So, for example, HSBC is this, is really getting a lot of press news lately about, it's just such a corrupt organization. It's been in bed with drug lords and every kind of money laundering and tax evasion. I mean, these guys are specialists in breaking the law, and of course have got away with it, have only paid the odd fine here and there, and have these, teams of the best legal representation money can buy. Anyway, they were also a major sponsor, of course, and advertiser in the Telegraph. And so as a result, when they were being investigated, the Telegraph kept not reporting responsibly on these events and sort of steering clear of, the coverage that they should be giving so that the public knows about these things. And so anyway, this editor finally stepped down. And it really goes back to my point, and I know I harp about the banks and the anarchy there a lot, and people may think I go over the top on it, but really it's so fundamental to the undermining of democracy, fairness, and recovery in the world today. Another sector, another study, I could go on for hours, Jim. It's just mind-boggling. The Bank International Settlements released another paper this week just showing without any doubt that a larger financial sector is literally, the larger the financial sector gets, the larger the black hole for brains, innovation, and productivity in the society. And that's where we're at today, and we do have antitrust laws. We have broke up conglomerates in the past that were no longer serving the public interest. We're way past that. Now we've got this sort of tangled web of debt and financial sales really running the show across the board, and it's contaminating everything that's trying to recover and grow in the world economy today. So I think we're on the verge of it. As I say, we're in the midst of the global contraction again. We've got highly levered financial markets and participants. We've got a whole bunch of corrupt actors running the show all over the place. I think we get one big washout phase here, finally, and you're going to have people wanting heads to roll, and perhaps we'll finally get some serious cleaning out of a much needed cleaning out of this corrupt financial sector.
I haven't seen any North American lawmakers say we're going to put bankers in jail if they go and rip us off again.
Yeah, I know, but there's a lot of people who are actually following and talking and saying and agitating, Elizabeth Warren, one of them, Bill Black's another one. There's lots of alternative commentary now available through the internet, because as I say, most mainstream business shows have been hijacked by these corrupt influences who are controlling the message. So there's no longer anything journalistic coming out of those entities. They're all sales machines for the finance sector. But you've got enough as I say, the only thing they've got going for them right now is that large cap stocks and corporate bonds have not yet blown up for a third time in the world, and certainly in North America. Everything else, if you look at all the sectors that matter to the world, they are all sort of heading back down. We've already seen that mean reversion back, as we've been talking about with commodities. Gold's come down a great deal. That was another highly, financialized market. You've got emerging market stocks coming back down, and now you've got high yield debt starting to mean revert again to the downside, thanks to all the disruption in the oil patch. So I think one after another, these financial bubbles are starting to deflate. And at some point, as I say, all they've got going for them is they can point to this crazy stock market, which happens to have, HFT blow-ups and flash crashes on an almost daily basis. It's truly become a laughing stock of anything, reliable or stable. But all they've got is pointing to price, saying, we'll see prices are up still, so everything's okay. Once you have that facade come off, once you have prices start to collapse again, I think then they have nothing to stand on, because their policies have been completely devastating to the real economy, wasted tons of good money after bad, and I really believe that they'll be out of political capital for extending those policies going forward.
We'll have some final thoughts from Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Danielle Park, her popular blog, Juggling Dynamite. In Europe, they have negative interest rates. They say the reason behind that is they don't want people hoarding money. Have you ever heard of such a term?
Yeah, well, first of all, it's a lot of factors. It's very complex. But first of all, we would have had low rates in the world in any event, right? Because we have, as I said, an aging population, first of all. But second of all, if you think about what they did, savings are supposed to be scarce in the world, right? Supposed to be savers are the ones who have money to advance for investment. Well, in the last few years, what they've done is they have increased debt so that it wasn't just saved capital that was available, it was levered capital, right? So they were able to create more cash and more cash and more cash out of this finite pool of savers by levering it up through derivatives. So really they flooded the system with the appearance of liquidity. So that drove down the price or the available or the value of capital. And so everyone's been having to, it's as if the world's full of savings, when in fact it's mostly debt generated money. It's not actual net capital. And so that's driven the yields down. But I think, and it may continue to do that for a while longer if the world's contracting and there's not a great deal of demand. That typically keeps rates low for longer. It does eventually, thank goodness, cut into the business models of these big banks, I think, because they are, at their core, they are supposed to be deposit-taking lending institutions. That's the essence of banking in the first place. So all the spreads have collapsed on that side as over the past few years as rates have moved lower and lower. And then, as I say, if we can get, some implosion on the risk-taking, speculating, commodities manipulating side, then you're also going to get, and we've seen that to a large extent, a drop-off in trading revenues and profits they're able to gouge out of that sector. And so once all that happens, I think it ends up being very negative for banks. You get a consolidation. Once you get a bursting of credit, and a contraction in the credit space, then you could see rates go higher again. But for right now, the world is literally turned upside down, and they're hurting everyone that's trying to make a decent, honest buck off of their savings in terms of, without taking crazy risk, is being hurt in this particular phase. So at the end, it simply can't go on forever, but it could, negative rates, I think that the shift back to the perceived safe havens is going to continue through the next several months as the world is going through this slowdown phase. And eventually rates could indeed start to move higher again. But for now, it's obviously detracting from spending, from the ability to have net cash flow and therefore to spend in the economy.
Danielle, thank you very much for chatting with us.
Hey, my pleasure, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. You can check out our YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.